They said it would never happen, yet here we stand, witnessing one of the most fascinating twists in the history of Bitcoin. The percentage of Bitcoin on major exchanges has plummeted below 15%, mirroring a realm of scarcity that few considered attainable just a handful of years ago. So, what is going on behind the curtains of these exchanges? And how could this sudden supply crunch reshape not only the price dynamics, but also the mindset of every Bitcoin holder around the globe? In today's deep exploration, we will dissect how institutional fervor, long-term accumulation, and private over-the-counter deals are reshuffling the supply-demand puzzle. Get ready for a journey that unveils the hidden mechanics of Bitcoin's drastic supply shock, and discover why every day you hesitate might be a day you miss out on this seismic shift. Strap in because our story begins with a sudden jolt of data that caught the cryptosphere off guard. The ratio of Bitcoin residing on centralized exchanges has dropped to its lowest level since back in 2018. Yes, you heard that correctly. 15% or even slightly less, as per certain market analytics. When supply on exchanges dips to historical lows, it signals that a whole lot of Bitcoin has migrated into cold storage, private custody solutions, or other places where coins are stashed away for the long haul. In other words, this is a potent signal that large-scale investors, or whales as many like to call them, are gearing up and tightening their grip on the world's most coveted digital asset. Before we delve deeper into why whales are hoarding so much Bitcoin, let us clarify the heart of our discussion, the phenomenon known as a supply shock. By definition, a supply shock arises when heavy buying activity collides with a starkly limited availability of coins. If people believe in the long-term promise of an asset and remove it from the marketplace, supply dwindles. Meanwhile, if fresh demand pours into that asset, especially from institutional investors hungry to feast on potentially large returns, you have the perfect blend for a wild price surge. But the situation is not as simple as demand goes up, price goes up. The cryptosphere harbors a complexity reminiscent of the global stock market, bond market, and even commodity trading. From center stage to behind the scenes, Bitcoin's diminishing supply is telling a much broader story. On the front lines, we have major cryptocurrency exchanges, those public-facing platforms where retail traders and institutions alike buy and sell. Exchange data, gleaned from watchers such as Glassnode, indicates that the downward spiral in Bitcoin reserves on these platforms is not a fleeting hiccup, but rather a sustained unraveling that signals a deeper shift in investor psychology. This phenomenon is not brand new. In fact, it has been steadily in motion since around 2018. However, the pace has accelerated in recent months, leading many analysts to claim that we are now on the brink of a rapid price revaluation, exactly because the ratio of available Bitcoin on these exchanges is so low. To see why the exodus of coins from exchanges might matter to you, think of it this way. Every coin that leaves an exchange is highly likely tucked away into longer-term custody, be it offline hardware wallets or institutional custodial services. These coins are, in theory, locked out of immediate circulation. Consequently, if a sudden influx of new investors attempts to purchase Bitcoin, the coins for sale will be drastically limited, potentially igniting a strong bullish price response. That is the core logic behind the supply shock argument. And let's be honest, who does not love hearing that a bullish setup might be brewing? Yet, the picture is incomplete without a full exploration of over-the-counter desks. These are the quiet backstage of crypto trading. Over-the-counter desks facilitate large private trades between institutions, hedge funds, and high-net-worth individuals who prefer not to move the market with massive exchange orders. Historically, these desks aim to hold enough Bitcoin reserves for swift deal execution. But we are seeing data that indicates these OTC balances are reaching all-time lows, which underscores a widespread shortage of readily available Bitcoin. With fewer coins in both the main marketplace, the exchanges, and in the quiet realms of the OTC world, that next wave of enthusiastic buyers might collectively push Bitcoin valuations through the roof. One reason behind the intensifying shortage is the much-discussed role of institutional interest. The notion that Wall Street is coming has been swirling within the crypto community for quite some time, but now we are seeing real, quantifiable footprints. Institutional inflows, especially those linked to the anticipated or actual launch of various spot Bitcoin exchange-traded funds, have soared. These funds often need to hold actual Bitcoin, meaning they must either buy those coins ahead of time or purchase them as demand for shares in the fund grows. That arrangement contributes to the supply drain, because once these coins land in the fund's custody, they are not typically sold on a whim. Consider a scenario. An institution sees the potential of a spot Bitcoin exchange-traded fund. That institution moves to secure a chunk of Bitcoin in expectation of positive fund performance or regulatory approval. Because these acquisitions happen in large chunks, the supply on exchanges erodes even further. Meanwhile, retail traders who might be curious about Bitcoin become engaged at the very moment it becomes increasingly rare to purchase. The friction between robust demand and meager supply intensifies. That is precisely why so many watchers describe the current environment as an unfolding supply shock, an inevitable collision between intensifying demand and diminishing availability. But where does that leave the price of Bitcoin? Here is the crucial piece. Many analysts posit that for Bitcoin to maintain its trajectory and fulfill its bullish prophecy, it has to anchor itself above 100,000. In previous cycles, Bitcoin's run-ups have encountered psychological thresholds like 10,000, 20,000, or 60,000, each of which stoked fervor. This time, 100,000 looms as that next big number, the line in the sand that many people see as a new baseline. If the market can defend a six-figure price tag and remain stable at that level, a further escalation toward 140,000 or even 200,000, numbers put forth by certain optimists, becomes not just possible, but potentially likely. Now, you might ask, how close are we to that magical threshold of 100,000? Some experts claim that if these supply constraints endure, the next wave of hefty buying pressure could catapult Bitcoin's price to levels that seemed unthinkable to casual observers just a year or two ago. Others caution that we could briefly dip below some critical support lines, generating short-term volatility. Although the short-term gyrations can be unnerving, especially for novices, many longtime believers are unflinching. They reason that Bitcoin's limited supply, 21 million coins in total, guarantees that scarcity remains a fundamental characteristic, especially as more major players join the fray. Let us take a closer look at another vital factor fueling this setting: the ongoing accumulation by so-called whales. Large holders of Bitcoin do not simply trade on a daily basis or flit in and out on short-term momentum. Instead, they methodically build their positions, transferring coins to deep storage each time they sense substantial upside potential. When whales accumulate, they often do it quietly, waiting for the right moments to strike, typically when public attention is subdued. The results are evident the next time you look at exchange balance charts. A big chunk of coins vanish, presumably into their private vaults. These patterns usually coincide with periods of low volatility, as whales prefer not to spook the market with abrupt massive orders. If you are enjoying these behind-the-scenes glimpses of Bitcoin's unfolding drama, why not consider tapping that like button? Your support helps us uncover more hidden truths about the cryptocurrency space and ensures that we can continue sharing insights that might otherwise remain buried. So, how do we know that whales are truly behind much of this accumulation? On-chain analytics, courtesy of groups like Glassnode, record the movements of large sums of Bitcoin, showing the path from exchange wallets to addresses that remain inactive for extended durations. Over-the-counter data also supports the narrative that big buyers are stepping in. Addresses known to be associated with minor operations or major funds have been declining in Bitcoin holdings, illustrating that many of those coins are being sold off, presumably to professional hands. Yet, we see a contradictory signal of strong institutional demand that never seems to slacken, at least when measured over longer timescales. Long-term confidence is further underscored by the resilience Bitcoin has shown amid market headwinds. While we occasionally see ephemeral downturns of 2 or 3% in a day, the broader trend has been a steady hold above the critical rung of 100,000, according to many forward-thinking pundits. Critics may roll their eyes and chalk it up to fleeting hype, but the data does not lie. Each time the market tests a potentially worrisome pivot level, it rebounds, underpinned by robust buy orders from an ever-growing supporter base. As we see more acceptance of Bitcoin as a store of value, perhaps even a new form of digital gold, these robust floors stand to solidify further. Now, to appreciate why the supply shock is so crucial, let us step back and examine Bitcoin from a macroeconomic viewpoint. Traditional fiat currencies can be printed at will by central banks, and commodities like gold have historically had their own challenges in terms of extraction or storage. Bitcoin, by contrast, operates on consensus rules baked into its code, ensuring that no more than 21 million coins will ever exist. At present, an estimated 19 million or so are already minted, leaving a vastly limited pool of new coins to be released over the next century. That scarcity, combined with relentless institutional demand, is what prompts many analysts to describe Bitcoin as digital gold on steroids. And that is not just a marketing line, it is a reflection of real dynamics of supply and demand. Another dimension worth mentioning is the narrative that the presence of exchange-traded funds linked to Bitcoin might attract more conservative or compliance-focused investors who previously avoided direct dealings with crypto exchanges. Spot Bitcoin exchange-traded funds, if widely adopted, could offer a streamlined avenue for people to get Bitcoin exposure through their conventional brokerage accounts, bypassing the complexities of setting up wallets and private keys. That convenience often triggers fresh capital inflows, and that capital needs real Bitcoin acquisitions in the background. Each share sold by these exchange-traded funds is likely backed by actual Bitcoin that must be held in custodial solutions, and those coins do not typically circle back to the open market quickly. Imagine the snowball effect that might occur if more large funds decide to jump in. Of course, no story is one-dimensional. Critics and cautious voices warn that if Bitcoin's price falls below that psychologically powerful threshold of 100,000, it could trigger massive long liquidations across the board, possibly resulting in billions of dollars in leveraged positions getting wiped out. Such an event would undoubtedly rattle confidence and potentially push adoption timelines forward or backward in unexpected ways. We cannot overlook the risk that over-leveraged participants might suffer if the market moves against them. Yet part of Bitcoin's resilience is precisely that it has weathered multiple storms over its decade-plus lifespan. In the grand scheme, each torrential dip has eventually been followed by an explosive rise, fueled by even bigger waves of mainstream acceptance. Where, then, shall this perplexing tale lead us by the close of 2025, or even further into the future? Some watchers foresee a scenario where Bitcoin's price breaks the boundary of 200,000. While more conservative experts lean toward the notion that 140,000 or so might be the near-future high watermark. What unites many of these perspectives is the assumption that demand will continue escalating due to ongoing inflationary environments, growing recognition of Bitcoin as a portfolio diversification tool, and an unrelenting stream of new institutional entrants. The supply shock that we are seeing is the canary in the coal mine for those who believe that Bitcoin is gradually but inexorably climbing to new summits. We should also not forget the personal motivations of Bitcoin holders, from average retailers to hyper-focused whales. Some treat Bitcoin as a hedge against fiat currency devaluation, especially in times when inflation hits everyday expenses like groceries and rent. Others see it as the building block of a novel economic order, where trust is algorithmic and transactions are borderless. Though these perspectives vary, they form a potent synergy that powers Bitcoin's phenomenon of adoption. Each new adopter who decides to lock away their coins for safekeeping intensifies the supply shock dynamic, and the cascade continues. On the other hand, if a segment of whales or early adopters decides to cash out massively, that could temporarily lift the supply on exchanges, easing pressure on the scarcity front. But so far, the data suggests the opposite. Persistent outflows from major trading platforms and consistent declines in OTC reserves. That is the double trouble scarcity mix that could make the next bull run unstoppable, at least until it reaches a point where many long-standing holders see an incentive to realize profits. As long as that point is far out of sight, the rally could gather formidable momentum. If you find these revelations stirring, or if you are intrigued by the idea that a single number, 15%, can reshape the conversation about Bitcoin's lasting opportunities, consider subscribing to stay informed. With every new twist in this saga, we will bring you insights that cut through the noise and get to the core of what this new monetary landscape means for everyone. Let us now consider one of the more overlooked but absolutely essential pillars in this narrative: the stability of Bitcoin's network itself. The concept of hash rate often enters the dialogue here, how robust the computational backing is behind the scenes. While short-term wobbles in hash rate can occur due to minor relocations or adjustments to energy policies, the overarching pattern has been one of relentless growth in the network's security. This intangible architecture, a synergy of cryptography and decentralized consensus, sets Bitcoin apart from any standard currency. When the fundamental network remains strong, holders have fewer reasons to panic sell, even in the face of negative headlines. This further cements the mindset that holding for the long term is the way to go, reinforcing the downward pressure on supply. Zooming back to the institutional sphere, it is vital not to overlook the significance of these major players. From corporate treasuries to hedge funds, each has a unique reason to snap up Bitcoin. Some see it as an inflation hedge, a digital counterpart to storing gold. Others are thrilled by the potential for large returns in an environment promising steady demand growth. A handful of major corporations have already put Bitcoin on their balance sheets, fueling speculation that more will follow suit. Each time such an announcement breaks, it heightens the spotlight on Bitcoin's finite supply. The more mainstream acceptance it gains, the tighter that supply could become. It is also worth noting that the ongoing wave of interest from institutions is not limited to the West. Across Asia, Europe, and other regions, institutional appetite is budding, spurred by the recognition that staying on the sidelines could mean missing out on possible exponential gains. In a sense, Bitcoin is positioning itself as a global asset class that transcends geographical and political dependence. It is not the exclusive playground of day traders or tech enthusiasts anymore. As more players enter, the shortage intensifies, fueling price growth that may shock even the most ardent cynics. Though short-term chaos could arise if the market hits a snag, the underlying fundamentals paint an optimistic picture. That said, each potential investor should realize that every market, even one as revolutionary as Bitcoin, carries a measure of risk. Sharp corrections and unexpected drops are not out of the question. The difference, at least according to many analysts, is that the magnitude of potential upside far outweighs the scale of possible temporary pullbacks, particularly when we weigh the unstoppable wave of new institutional inflows against the evidently shrinking supply. And so, we circle back to the rallying cry. The supply shock is real. It has been building momentum for years, but the puzzle pieces have now coalesced into a coherent picture. Exchange balances are draining, over-the-counter reserves are hitting historic lows, and whales are quietly stocking their vaults. Even miners have to navigate an environment where their newly minted coins are quickly absorbed by the unrelenting demand from big buyers. If these elements hold their course, then it might only be a matter of time before Bitcoin breaks into an era of six figures, establishing 100,000, not just as a fleeting milestone, but as a robust foundation for future expansions. Now, let us pivot to discuss the emotional dimension, the thrill, the anxiety, and the sense of opportunity. For countless newcomers, Bitcoin represents that once-in-a-generation chance to plant roots in a still-developing frontier. For long-time participants, each new supply crisis is a reaffirmation that their convictions might have been correct all along. Nonetheless, the cryptosphere is seldom predictable. While the supply shock storyline is compelling, black swan events or macroeconomic upheavals can rewrite the script in the blink of an eye. That is why many suggest diversifying risk and stepping carefully, no matter how bullish the signals appear. The final question is, are you prepared for what is coming next? Are you ready for the possibility that the shortage of Bitcoin could magnify over time, pushing prices into realms that no one would have dared predict a few short years ago? Or do you dismiss the idea of a supply shock as mere hype, convinced that tighter regulations or external forces might stifle Bitcoin's continuing ascent? These are the sorts of questions that every observer must answer. From the vantage point of many outspoken analysts, failure to hold 100,000 as a psychological threshold would definitely cause some ripples. Some estimate that billions upon billions of dollars in leveraged positions could be wiped out if Bitcoin falls below that noteworthy line. Yet others claim that any major sell-off would be in vain, as buyers on the sidelines are only too eager to scoop up more coins at discounted valuations. This tension between potential meltdown and unstoppable rally may well define the next stage of Bitcoin's saga. To sum it all up, the unstoppable synergy of institutional hunger, unwavering hodlers, and decreasing exchange balances is forging a perfect storm in Bitcoin's supply and demand matrix. The stakes have never been higher, and the excitement around potential new all-time highs remains as electric as ever. The story is bigger than mere price tags. It is about a paradigm shift in how the world perceives digital assets, sovereignty over personal finances, and the unstoppable drive toward a decentralized future. Those final coins left on exchanges or in OTC inventories might become the prime targets of the next wave of adoption. Meanwhile, Early adopters and whales, if they hold their nerve, could once again reap the benefits of this radical transformation. One thing is certain, the narrative around scarcity is not going away. It is quickly becoming a key talking point for every conversation about Bitcoin's long-term trajectory. Whether you are a seasoned trader, a curious newcomer, or merely a spectator of financial history in the making, you cannot ignore the signals any longer. The scarcity storyline is unfolding right here, right now, and everyone is invited to watch or to take part. So, as you reflect on the possibility of Bitcoin forging beyond 100,000, 200,000, or even more uncharted territory, ask yourself, is this the moment to ignore the headlines and dive deeper, or do you stay on the sidelines, letting fear overshadow potential gains? The answer is profoundly personal and will vary from one individual to another. But keep in mind, each day that passes might increase the likelihood of an accelerating supply shock that shows no signs of slowing down. We have covered a vast landscape, from the plunging exchange balances to the hush-hush dealings of over-the-counter desks, from the massive wave of institutional adoption to the mesmerizing question of whether the big players are quietly scripting Bitcoin's next monumental move. There are still countless layers to peel back, but the central theme remains. As more coins vanish from markets and land in ironclad custody, the fuse on Bitcoin's potential rocket grows shorter. If even a fraction of the predicted demand flows in, watch out, because the coin shortage might become the catalyst for a price explosion that rewrites the record books. No one can say for sure exactly where this ends, but there is no shortage of excitement, tension, and fervent speculation. For now, all we can do is observe the data, track the flows, and gaze toward that mythical 100,000 line that could catapult Bitcoin from a mere competitor in the financial world to a protagonist in a new era of money. And that, dear listeners, might be the greatest show in finance we have ever witnessed.